Okay, so today we're going to pull back the curtain on a day that left a lot of people on Wall Street just scratching their heads. The headlines were screaming one thing, a record high. But the real story, the one that actually mattered, was hiding in plain sight. Let's dig in and find it together.
So, picture this, the S&P 500, which is, a huge benchmark for the entire US stock market. It just smashes through a major ceiling. It flies past 7,000 points for the first time ever, hitting this incredible high. This was it. This was the big moment. Or so you'd think.
But, and this is where it gets weird, despite hitting that massive peak, by the time the closing bell rang, nothing. The market actually slid backward, and in the day down just a tiny fraction of a percent, basically completely flat. So what on earth just happened?
All right, so that brings us to our first big puzzle. The mystery of the record high that wasn't. The champagne was on ice, but nobody was celebrating. Why?
I mean, seriously, why would a day that broke records end with such a whimper? The answer is really the key to understanding how the pros look at the market, and we are about to unlock it.
To solve this thing, we have to look past that big, flashy headline number and actually decode what the market was feeling. This is where we learn to separate the real news from just the noise.
Your average news report would just say the market was flat. But an expert, they see a crystal clear signal. A brand new high that gets sold off almost immediately is a textbook sign of profit-taking. It's this classic tug-of-war between buyers and sellers, a pattern they call rally meets supply. Just imagine a huge wave of excited buyers pushing prices up to a new record. But right at that peak, they slam into a giant wall of sellers who've been riding that wave up and are now saying, "Thank you very much, I'm cashing out." That's rally meets supply.
And here's the absolute crucial point. This wasn't a show of market strength. Not at all. It was a warning flare sent up by the sellers, basically telling everyone they were in control up there and were ready to stop the party.
But that wasn't the only thing going on that day. Oh no, there was another massive event that had the entire market holding its breath, the Federal Reserve's big decision on interest rates.
So the Fed comes out and does exactly what everyone expected. They kept interest rates right where they were. They did this delicate little dance, saying the job market looks okay, but inflation is still a bit of a problem. Now, this was the move everyone saw coming, but the real story was kind of hidden in the subtext.
See, the real story wasn't the pause itself. It was that they broke the pattern. For 3 straight months, they'd been cutting rates. Cut. And now, a pause. This was a big signal that the Fed was shifting gears into a more cautious, let's wait and see mode.
And this highlights something so important. The textbook tells you lower rates are good for stocks, but the pros know it's way more complicated. If the Fed is cutting rates because they're worried the economy is weak, well, that's actually terrible news for company profits. And profits are what really drives stock prices. The why behind the cut, that's everything.
Okay, so if the stock market's reaction was basically a collective shrug, because the news was already priced in, where was the real action? Where were the pros actually looking for clues? This is the million-dollar question on any big news day, right? When the main event is no surprise, the smart money isn't just staring at the S&P 500. Nope, they're looking for the real story in some less obvious places.
And here's where they were looking: the bond market. They were watching government bond yields to see what the economy might do next, the yield curve for any recession warnings, interest rate futures to guess the Fed's next move, and credit spreads to see how scared investors were. These are the instruments that tell you the unfiltered truth.
There's a fantastic quote that just sums this up perfectly. Watching only the stock index on a Fed day is like watching the scoreboard but ignoring the players on the field. It's so true. The stock index is just the final score. The bond market, that's where you see the whole game play out. But wait, there was one more huge piece to this puzzle. Looming over the entire day was the fact that some of the biggest companies in the world were about to report their earnings right after the market closed. And after the bell, bam, the numbers came in, and they were strong. Tech giants, we're talking Microsoft, Meta, Tesla, they all crushed expectations. A big dose of good news for the market. Which leads us to another really interesting question. If this fantastic news was right around the corner, why wasn't the market more pumped up during the day? Why wasn't there a bigger rally? The answer lies in a really important concept called market breadth.
So market breadth basically asks a simple question. Is the whole team playing, or is it just a few superstars carrying everyone else? A really healthy, sustainable rally is broad, meaning lots and lots of different stocks are going up together.
And that was the hidden risk that day. The rally was super narrow, it was being propped up by just a handful of these huge tech companies. The problem is, if those few giants stumble, they can drag the whole market down with them. A narrow rally is a fragile rally, and the pros could see that the rest of the market just wasn't playing along.
Okay, let's wrap this all up. Let's talk about how you can use all these little insights to look right past the headlines and find the real story for yourself. Here is your 4-step pro checklist. First, go ahead and look at the headline number like the S&P hitting 7,000. But then, step 2, immediately ask, what did everyone already expect to happen? Step 3, take your eyes off stocks for a second and look at the bond market for the real reaction. And finally, step 4, check the market's breadth. Is this rally for real, or is it just a house of cards?
So the next time you see one of those big, flashy market headlines, you'll have the tools to see what almost everyone else misses. You'll be able to look beyond that one number and uncover the real story hiding underneath. The only question is, what are you going to find?